Regional banks imploded and Bitcoin went up 40 to 50%. So I think this recognition that, and I know I've pivoted here a little bit from that paper to the topic at hand, but I think that realization that Bitcoin is not only a risk on asset, a technology, as technology is, but it is a risk off asset in terms of counterparty risk. There's no counterparty risk here like there is in the banking system.
In recent days, spot Bitcoin ETFs have lost interest for the average individual. Over the past week, BlackRock's IBIT and other spot Bitcoin ETFs have set fewer records, and the cryptocurrency price has been erratic. Experts think this is just the beginning, and that the new wave of investors who have invested billions into the market has much to offer. In an early January interview, ARK Invest founder and CEO Cathie Wood stated she was excited for Wells Fargo, Morgan Stanley, and Merrill Lynch to provide spot Bitcoin ETFs. Bitwise CEO Matt Hugin predicted a massive institutional demand wave once major banks issue Bitcoin ETFs that week. Added, "I think there's an even bigger wave coming in a few months." Cathie and Matt recently provided insight into these statements. Both still expect the next massive institutional demand wave to be stronger than any since the ETFs were approved in January. Cathie discussed what she expects from 21 Shares co-founder Ophelia Snyder in a recent Empire interview. Cathie and Ophelia discussed Wirehouse's upcoming institutional demand wave in the interview. Cathie's $1.5 million Bitcoin prediction and Ethereum ETF approval probability before 2024. We'll show bits of the interview and Matt's enthusiastic comments about Bitcoin ETFs and multi-trillion-dollar investors. Watch the complete video to avoid missing the critical information from two of the top 5 Bitcoin ETFs founders. Help us reach more crypto aficionados with this video. Subscribe for videos. You boost the YouTube algorithm and channel growth with everything you do. Thanks, and enjoy the film.
Summarized it as the journey back because that really references how long duration assets were pummeled during 21 and 22 as interest rates went up. So interest rates, the Fed increased interest rates 24-fold. That has never happened in history. You go back to the 80s when Chairman Volcker was trying to put a stop to inflation, and he took interest rates up 2-fold. This was more than 10 times that magnitude. And many people were dismissing it, saying, oh, interest rates were so low. Back then they were 10%, he went to 20%. Yeah, they had been the businesses, consumers had been getting used to it over 10 years, maybe more than that. This time it was just a shock. And what we believe has happened is a rolling recession here in the United States. Housing is down 20 to 40%, depending on the measure. Autos they're not in expansion territory. They're closer to recession territory in the 15 to 16 million unit annualized rate range. You have commercial real estate in a world of hurt, office and now multifamily. You have bank deposits still leaving the system. They're still negative on a year-over-year basis. And in fact, they're now negative over last year's negative. So it's a double whammy. We don't think the regional bank crisis is over. And finally, companies are losing pricing power. So inflation as measured by the CPI has come down from 9% to 3%. So we no longer have to fight we're in a 70s style inflation and it's not going away. This is, we're going to end up in the high single digits. So we're not there. We're at 3%. Now people are saying, oh, stagflation. We haven't reached the Fed's 2%. We listen to earnings reports and listen very carefully for pricing power. Companies are losing pricing power. Those who are trying to fight the unit declines with higher prices to salvage their margins are getting hurt, and they're going to end up cutting prices. Walmart saying prices are negative, we're in deflation, and Costco is saying they're flat, moving into deflation. So we think companies are going to lose pricing power, and that is going to accelerate the shift towards innovative solutions to this problem. And that's what our 5 major innovation platforms are all about. So robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing. So they touch every sector, and they are converging. And this is what we think a lot of traditional asset managers are missing, the convergence between and among these technologies. And they're highly deflationary. Now, many people are saying, well, wait a minute, isn't Bitcoin a hedge against inflation? Isn't that the reason to own it? Why are you such a big proponent of it when you think there's actual deflation happening? Well, if you look, when we took our first exposure to Bitcoin in 2015, it was $250, and traditional asset managers and others in the ETF space were making fun of that decision. And so we paid very close attention to the daily moves. And at the time, Greece was threatening to leave the European Union. And we were worried about, a relapse into the European sovereign debt crisis. Well, if you were watching Bitcoin very carefully back then, you saw it nudged up every time that there was a flare up around Greece. And that gave us confidence that Bitcoin might be a risk off asset as well as a risk on asset. And that was confirmed last year during the regional bank crisis, when regional banks imploded and Bitcoin went up 40 to 50%. So I think this recognition that, and I know I've pivoted here a little bit from that paper to the topic at hand, but I think that realization that Bitcoin is not only a risk on asset, a technology, as technology is, but it is a risk off asset in terms of counterparty risk. There's no counterparty risk here like there is in the banking system.
Cathie is very sure that the next wave of institutional demand for Bitcoin ETFs will be much bigger than anything we've seen so far. As a result, she's even more optimistic about Bitcoin, which she thinks will reach $1.5 million per coin in about 6 years. The only catch is that these wirehouses are taking their time to really understand this new asset class, especially since it's all about investments. Cathie and Ophelia also talked about how likely it is that the SEC will approve other crypto-based ETFs, especially Ethereum spot ETFs, before the end of the year. Cathie is not optimistic about the approval of Ethereum ETFs until there is at least a change in the SEC's leadership. Ophelia thinks the chance might be better than most people think. Here are more interview clips.
I think it's important to realize what institutional behavior looks like when you come into a new asset class. And this is a new asset class, right? And yes, it can fit into commodity buckets. And yes, you can think of it in a store of value, but it is fundamentally something new and different, right? And we're trying to find corollaries, but there is quite a bit that's novel here. The behavior is quite simple. You go from, this is crazy, why would I buy this, to, well, wait a second, now I need to at least have an opinion about this. And I think that's where most of the United States pretty radically shifted into in January. It went from being completely fine to have no opinion whatsoever on crypto. And you could tell your clients that and they wouldn't find that weird, to now clients not accepting that as an answer. You can say you hate it, but you need to have a well-founded opinion. It needs to be based on something and not just whatever. And I think that was a pretty big shift. And we've seen that happen in other markets. It happened in Europe a few years ago. It's continuing to happen. The arrival of the US ETFs has accelerated that globally. But I think that's really where we're sitting. They're developing opinions. You then see people do what I would call like testing the waters or dipping a toe in. They'll throw like a tiny allocation, like a something, just see, how does this perform in my portfolio? How do my clients react to this? These are still 70 vol products, right? And you're not going to get the kinds of returns that you see without volatility. That's literally definitionally how you measure volatility. You need, they go together. This is not, but it's not something, a lot of more traditional investors are used to seeing in their portfolio. They're used to much more steady returns in some respects. And I think, so you're seeing people add a little bit, then you'll start to see them build full allocations. And we've had customers, not in the US market, because obviously that's newer, but we've had institutional customers in other markets who started by allocating $10,000 or $100,000 to Bitcoin in a multi-$100 million portfolio just so they like kept an eye on it and had a reason to look at it. And now they hold tens, some of our clients hold hundreds of millions in assets ranging from Bitcoin to some pretty esoteric alts. And I think there's definitely a learning curve there. We're very early in that in the US. Like the educational process for learning what these assets are and understanding how they can fit in your portfolio is very, very early still.
As promised, comment on Cathie and AIA's interview. In his latest weekly email to investing professionals, Bitwise CEO Matt Hugin, who shared its digital wallet address in January, predicts another large surge of institutional demand for spot Bitcoin ETFs. CEO Matt of Bitwise encouraged investors to ignore Bitcoin's recent price fluctuations and adopt the long view. After Hing and national account platforms like Morgan Stanley and Wells Fargo approve the ETFs later this month, Bitcoin's short-term holding pattern will shift. Matt thinks this historic event might happen in weeks. The Bitwise CEO wrote in his memo, "Bitcoin may fluctuate on little emotion movements, but we feel it is in a raging bull market. It has gained 300% in 15 months, and there are strong grounds to believe it will continue." He stated in the Matt stated that spot Bitcoin ETF investors control over $100 trillion and will inject $1 trillion into Bitcoin if they invest 1%. Investment professionals first entered the crypto market in January with spot Bitcoin ETFs. These investors possess tens of trillions of dollars, possibly over $100 trillion, and are just entering crypto. The $12 billion that has poured into ETFs since January excites us, but think what global wealth managers invest 1% of their portfolios in Bitcoin, which would bring $1 trillion into the base against this $12 billion down payment. Matt expects BlackRock and other spot Bitcoin ETFs will raise only 1% of the billions coming in the next years. You concur. How big will Bitcoin in the digital assets business be? Comment below, like this video, subscribe to the channel, and enable post alerts for more videos like this. Thanks for watching.